Today, we're diving into the minds of the world's greatest investors. These are people who didn't just make money. They built fortunes, survived crashes, and changed how investing is done forever. In this video, we'll explore the profiles and strategies of legendary investors like Warren Buffett, Ray Dalio, and other iconic names who mastered the markets over decades. But this isn't about copying their exact portfolios or trying to get rich overnight. It's about understanding how they think, how they manage risk when markets crash, how they stay disciplined when others panic, and how simple principles, patience, consistency, and long-term vision helped them outperform millions of investors. Whether you're a beginner or already investing, these lessons still apply today. By the end of this video, you won't just know who these investors are, you'll understand what you can actually learn from them and how to apply their mindset to your own investing journey. Let's begin. Warren Buffett's Investing Principles: Timeless Lessons for Long-Term Wealth. When people talk about the greatest investors of all time, one name always comes up: Warren Buffett. He is known not just for his wealth, but for his calm, patient, and disciplined approach to investing. Buffett didn't get rich by chasing trends or trading every day. He built his fortune slowly, over many decades, using simple ideas that anyone can understand. In this video, we'll explore who Warren Buffett is, how he thinks about investing, and the timeless lessons we can apply to our own financial journey. Who is Warren Buffett? Warren Buffett is often called the Oracle of Omaha. He is one of the richest and most successful investors in history. But what surprises many people is how he built that wealth. Warren Buffett did not become rich overnight. In fact, most of his net worth came after the age of 50. This alone teaches us a powerful lesson: investing rewards patience. Buffett started investing at a very young age and stayed committed for decades. He didn't rely on luck, hype, or quick wins. He relied on time, discipline, and consistency. While many investors chase fast profits and market trends, Buffett focused on long-term ownership. He treated stocks as real businesses, not lottery tickets. He believed in buying strong companies, holding them for years, and allowing compound growth to do the work. There were market crashes. There were long periods with no excitement. But Buffett stayed calm and stayed invested. His story reminds us that wealth is often built quietly, slowly, steadily, not through shortcuts, but through patience, long-term thinking, and the discipline to stay the course. Buffett's core philosophy. Warren Buffett follows a strategy known as value investing, an approach strongly influenced by his mentor, Benjamin Graham. At its core, value investing is about buying something for less than it's truly worth, and then having the patience to wait. Buffett's philosophy can be summarized in 3 simple ideas. First, buy great businesses. Not popular stocks, not trendy companies, but businesses with strong brands, loyal customers, and consistent profits. Second, buy them at fair or discounted prices. Even a great company can be a bad investment if you overpay for it. Buffett looks for a margin of safety, room for mistakes and market uncertainty. Third, hold them for a very long time. Buffett does not trade in and out of positions. He lets time and compound growth do the heavy lifting. He does not try to predict market movements. He does not react to daily headlines, breaking news, or short-term price swings. Instead, Buffett focuses on the quality of the business itself. He asks simple but powerful questions. Is this company strong? Is it stable? And will it still perform well 10 or 20 years from now? To Buffett, buying a stock means buying ownership in a real business. And as he famously says, if he wouldn't want to own the business for 10 years, he won't own the stock for 10 minutes. That mindset is what separates long-term investors from short-term speculators. What Buffett looks for. Before Warren Buffett invests a single dollar into a company, he asks a few very basic but extremely powerful questions. First, is the business easy to understand? If Buffett can't clearly explain how a company makes money, he immediately loses interest. Second, does the company have a strong and trusted brand? Great businesses don't need to fight for attention. Customers return because they trust the product. Third, does the business generate consistent profits over time? Buffett prefers steady earnings, not flashy growth that disappears when conditions change. Fourth, does the company have a competitive advantage? Something that protects it from competitors, like brand loyalty, pricing power, or high switching costs. For Buffett, clarity is more important than complexity. If a business feels too complicated, he doesn't try to force understanding, he simply walks away. For many years, Buffett avoided technology stocks completely. Not because technology was bad, but because he didn't understand those businesses well enough at the time. This idea is known as Buffett's circle of competence. He only invests in areas where his knowledge gives him confidence. His rule is simple and powerful. Never invest in something you cannot clearly explain, especially to yourself. Buffett's view on risk. Most people believe risk means market volatility. They think risk is when stock prices move up and down every day. When markets fall, fear takes over. Headlines turn negative, and many investors panic. But Warren Buffett sees risk very differently. Buffett once said, "Risk comes from not knowing what you're doing." To him, risk is not temporary price drops. Risk is buying businesses you don't understand. Risk is paying too much for a company, no matter how popular it is. Short-term volatility is normal. Markets rise and fall all the time. But those movements do not change the true value of a strong business. This mindset allows Buffett to stay calm during market crashes. While others panic and sell at a loss, he often looks for opportunities. History shows that some of Buffett's best investments were made during periods of fear and uncertainty, when prices were low and emotions were high. Because Buffett understands what he owns, he doesn't fear short-term declines. He focuses on the long-term strength of the business, its earnings, its management, and its ability to survive tough times. He trusts that strong businesses will recover, adapt, and continue to grow over time. For Buffett, managing risk is not about predicting the market. It's about knowledge, discipline, and owning quality businesses at the right price. That is why, while others panic, Buffett remains patient and confident. Key lessons from Buffett. There are several powerful lessons we can learn from Warren Buffett, lessons that apply to any investor at any level. First, long-term thinking beats short-term trading. Buffett doesn't chase quick profits or daily market moves. He believes real wealth is built by owning great businesses and giving them time to grow. Second, simple strategies often outperform complex ones. Buffett avoids complicated formulas and risky speculation. Instead, he focuses on businesses he understands, with strong fundamentals and consistent earnings. Another key lesson is that understanding your investments reduces fear and panic. When you truly know what you own, market drops don't scare you as much. You stay calm while others panic. Buffett also teaches that emotional discipline is more valuable than raw intelligence. You don't need to be a genius to succeed in investing. What you need is patience, consistency, and self-control. He focuses on what truly matters and ignores market noise. Even when others doubt him, Buffett sticks to his strategy. These habits, practiced year after year, are what actually build long-term wealth, not luck, hype, or shortcuts. Who is Ray Dalio? Ray Dalio is one of the most influential investors in modern financial history. He is the founder of Bridgewater Associates, one of the largest and most successful hedge funds in the world, managing hundreds of billions of dollars for governments, pension funds, and major institutions. But Ray Dalio is very different from traditional investors like Warren Buffett. While Buffett focuses on individual businesses, Ray Dalio focuses on the entire economic system. Dalio studies how the economy works the same way an engineer studies a machine. He believes markets are not random. They move according to patterns, incentives, and long-term cycles. And once you understand those patterns, you can make better decisions, not just in investing, but in life. Ray Dalio's view of the economy. Ray Dalio believes the economy is driven by a few powerful forces that repeat over time. At the center of his thinking is one key idea: the economy works like a machine. According to Dalio, the most important forces behind this machine are debt cycles, interest rates, money printing, and economic incentives. Almost everything in the market, Dalio explains, connects back to debt. When people and businesses borrow money, spending increases. More spending leads to more income, and the economy grows. But when debt grows too large, the system becomes fragile. Payments become harder to make, growth slows, and risk begins to build under the surface. At this point, central banks step in. They lower interest rates to encourage more borrowing. And when that is no longer enough, they begin printing money to keep the system from collapsing. Dalio has spent decades studying these cycles, going back hundreds of years across different countries and empires. By comparing history, he noticed the same patterns repeating again and again: economic booms, slowdowns, crashes, and recoveries. These cycles are not random. They are the result of cause and effect. Dalio calls this understanding how the economic machine works. And once you understand this machine, you can better prepare for changes, manage risk, and make smarter decisions, not just in investing, but in understanding the world around you. Macroeconomics over stock picking. Unlike many investors, Ray Dalio does not focus heavily on picking individual stocks. He cares less about whether one company beats another or whether a single stock outperforms the market. Instead, Dalio steps back and asks bigger questions. Where are interest rates going? Is inflation rising or falling? Are governments increasing debt? Is money being printed or tightened? Dalio believes these forces matter more because they affect everything at once. When interest rates rise, borrowing becomes more expensive. That impacts businesses, housing, and consumer spending. When inflation increases, purchasing power falls, and investors are forced to adapt. When governments borrow heavily or print money, asset prices may rise, but long-term risks also begin to build. These macroeconomic forces influence all asset classes: stocks, bonds, real estate, commodities, and currencies. That's why Dalio focuses on understanding the entire system, not just individual companies. For Dalio, successful investing isn't about finding one winning stock. It's about understanding the big picture and positioning yourself as the system changes. The all-weather portfolio. One of Ray Dalio's most famous investment ideas is the all-weather portfolio. The goal of this strategy is not to achieve the highest returns in good times. The real goal is survival and stability in all market conditions. Dalio believes markets move through four major economic environments that repeat over time. First, rising economic growth. Second, falling economic growth. Third, rising inflation. And fourth, falling inflation. Each environment rewards different types of assets. During periods of rising growth, stocks often perform well as companies expand and profits increase. When growth slows or declines, bonds can perform better, as interest rates tend to fall and investors seek safety. During times of rising inflation, commodities and gold help protect purchasing power as prices increase. And during extreme uncertainty or financial stress, cash and defensive assets provide flexibility and stability. The problem is that no one can consistently predict which environment comes next. Because of this uncertainty, Dalio does not bet on a single outcome. Instead, he spreads investments across multiple asset classes, each designed to perform well in different conditions. This diversification reduces risk, smooths long-term returns, and helps investors avoid catastrophic losses. The all-weather portfolio is not about being right. It's about being prepared. Instead of betting on one future, Ray Dalio prepares for all possible futures. Principles over predictions. Ray Dalio does not rely on a single prediction. He doesn't say, "This will definitely happen," or "The market can only go one way." Instead, Dalio thinks in probabilities. He looks at multiple possible outcomes and asks a simple question: what could happen, and how likely is each scenario? Rather than betting everything on one forecast, Dalio prepares for many different futures. He then builds portfolios and systems designed to survive even when he is wrong. This approach changes everything. It removes the emotional pressure of needing to be perfectly right. It reduces overconfidence because no single view dominates the decision. And it shifts the focus from guessing the future to managing risk intelligently. Dalio believes the world is too complex for certainty. Economic systems are influenced by incentives, policy decisions, human behavior, and unexpected events. Because of this, predictions fail far more often than people are willing to admit. That's why Dalio emphasizes principles. Clear, tested principles guide decisions across changing environments. They help investors stay disciplined during booms, crashes, and uncertainty. In Dalio's view, long-term success doesn't come from making bold guesses that occasionally work. It comes from building systems based on strong principles that perform reasonably well across many different outcomes. For Dalio, principles beat predictions every time. Key lessons from Ray Dalio. There are several powerful lessons everyday investors can learn from Ray Dalio, one of the most respected investors and thinkers in the world. The first lesson is to understand the economic cycle. Markets do not move in straight lines. They move in patterns: expansion, peak, slowdown, and recession. When you understand where we are in the cycle, market moves start to make sense. This helps you avoid panic during downturns and overconfidence during booms. The second lesson is that diversification reduces risk. Dalio strongly believes you should never rely on one asset, one sector, or one prediction. Even the smartest investors are wrong sometimes. By spreading your money across different assets, you protect yourself when one part of the market fails. The third lesson is to avoid emotional decision-making. Fear and greed are the biggest enemies of long-term success. Dalio teaches investors to build rules, systems, and clear principles that guide decisions, especially during stressful market moments. When emotions are high, systems keep you disciplined. And finally, Dalio emphasizes survival above all else. Staying in the game long enough is more important than winning quickly. Big losses can permanently damage your ability to recover. If you protect your downside, opportunities will always come later. Ray Dalio's approach reminds us that successful investing is not about being right all the time. It's about managing risk, thinking long-term, and staying rational through every market cycle. Comparison and analysis: Buffett versus Dalio. Now let's compare these two legendary investors. Warren Buffett and Ray Dalio approach investing from very different angles, but both have achieved extraordinary long-term success. Buffett is business-focused. He looks for great companies with strong brands, consistent profits, and long-term competitive advantages. Once he finds a business he understands, he is willing to hold it for decades. His strategy is simple, patient, and grounded in value. Ray Dalio, on the other hand, is macro-driven. He focuses less on individual companies and more on the entire economic system. Interest rates, inflation, debt cycles, and global trends play a central role in his decisions. Instead of concentrating on a few businesses, Dalio diversifies across asset classes to prepare for different economic environments. Buffett trusts his understanding of specific businesses. Dalio trusts systems, data, and diversification. One investor wins by deep focus, the other wins by balance. Different paths, same core lesson. Successful investing is not about copying a style. It's about choosing an approach that fits your mindset, knowledge, and discipline. Thank you for watching this long-form lecture. If this helped you, please like, subscribe, and comment below which investor you want to deep dive on next.